Hey everybody, welcome back. Well, the question on everyone's mind is the stock market crash over? Could we constitute this as a crash? Well, yes and no, and we're going to talk about why it might be over and why it might not and what you need to focus on. So I'm going to get into some slides to just start and then we'll go from there. But obviously we can see the drop if we do the simplest of things and just come here and click on this bar and measure the 50% line. We closed at exactly 50%. And really what that's showing us is that buyers and sellers are still fighting, and there's a lot of reasons for that. So let's get into the issues. Now, a week ago, we got into this and discussed that the carry trade that was going on with the dollar and the yen was an issue. You can go back to that video. It was literally last Monday or Tuesday. And what's important about this is, let's just review what this is, because it's not just this that's the problem. So in other words, when you have a weak yen, or it's cheaper, or a cheap currency, people will sell that currency, buy the dollar, and then buy dollar instruments. When that stops, it reverses. It's reversing on steroids right now because this is the first time that they've hiked rates. Now, what people are not aware of is that there's a lot of interbanking relationships that are in here. And this was picked up today, finally, by the Wall Street Journal. We're going to get into it because this is the part of the trade that I don't think most people are getting. See, most people will equate this trade to the NASDAQ 100, and that kind of needs to come to parity. And I'll show you that as well. Arete did some great work on that. But it's important for you to look at this and go, oh, well, that's clearly that's over, right? I mean, a lot of people are going to look at that and think that. The problem with that is it just might not be true. When you look at NKD here, let's get this going here. There we go. When you look at NKD here and we see this bottom, I'll clean all this off and we'll start over. You can see our level right here, and we ran through it, and now you look like you've bounced. This takes a lot of construction. You form some kind of H, you kind of retest this area. It's not, oh, we made a mistake, everybody back in the water because we sold. No, this still has to set itself. You have to see what kind of margin requirements are out there, how that's going to change. And the Fed is really falling on deaf ears right now. So this is what we have going for us. And I do think it's important to just note we hit the circuit breakers. If we're going to get into the simple things first, do I see that the VIX pulled back? Did it? Did the VIX pull back? Well, it's not at 69, okay, or 65. Okay, well, it went to 30 the other day, and then it closed at 23. Was it over then? So this idea that the VIX is over while it's still hitting higher highs, I wouldn't like rest my hat on that. I think what you could say is, did we get to an extreme level today? Yes. Did anything really change during the day? When we start looking at these charts, technically, the answer is going to be a resounding no. Did it present some opportunities to buy? Yes, it presented a lot of opportunities to buy, and we'll show you how you can look at these trades and move forward. But the important thing about this is understanding what's happening. You are deleveraging across the board, and that does not mean that you're just going to start leveraging again. So let's get into some of these issues and look at the rate cuts, but let's really understand what the issue is. So instead of just throwing things against the wall and seeing what sticks, we actually know what the problem is, and then we can fix it and make money off of it. Now let's just start with the basics, and we're going to jump around here a little bit, but let's get to what's going on. So there's a 100% chance of an ease by December. This is CME Fed tool. This is the current rate that we are at, 525, 550. If you take a look at what they're saying by December, and we would just look at where the meat of this is, you're going to get the 450 to 400 to 425. Well, that's telling you that you're looking at anywhere between 100 to 150 basis points in cuts. To get to the 150 basis points, you would cut 3 consecutive times of 50 basis points. This is 3 consecutive times of 50 basis points. I just want you to kind of think about that for a second from where we were. And if you really look at where we were, just 1 week ago, there was a 0.2% chance of that. And now you're at a 43% chance of that. I just want you to kind of wrap your noodle around that as we go forward, okay? We have shifted massively. And that shift has changed. I mean, you can see right here, a 36% chance of being at the 475, 500 level. And now that's not even on the radar. There's 0 chance that you're there right now. You had a 53% chance of being at 450, 475, which was 75 basis points. And now you look at the chance of being there, 53. There's only a 5% chance of being there a week later. All this since Powell spoke. My sense of this is here's November, and you can just take a look at this. 425, 450 by then. So to get there, that's 50 basis points. So they're saying 50 in September, 50 in December, or 50 in September and 50 in November. That's a 40% chance. 50 and 25 by then, 52% chance. Add these together, you get an 82% chance of somewhere between 75 to 100 basis points in cuts in the next 2 meetings. Do you think he should have cut in July? You can think anything you want, but it's very clear. This is very objective data, and these are the people that actually make the bets. and they're telling you what should have happened. The one thing I learned in 25 years of doing this, you don't bet against the bond market. You just watch what the bond market does, because that's where the real money is. 14.5% chance of only one cut in September, 14.5%, and now you're at almost 86%. Put that into perspective. A week ago, you had an 11% chance of being here, and now you're at an 85, and every day it's going up and up and up. It's not getting better, it's getting worse. Why? Now, I am not a huge CNBC guy. I'll just leave it at that. I don't watch it. But Siegel, when this guy speaks, you should probably pay attention to what he's saying. He's probably one of the foremost experts out there on the bond market and the relationship of the equity risk premium to stocks. He really understands what he's doing, candidly. I'm calling for 75 basis point emergency cut to the Fed fund rate with another 75 basis point cut indicated for the next month. That's the minimum on what they need to be doing right now. This is because of the unwind, and people are trying to look at this and say, well, it's because of the spread of the unwind, which we showed you earlier. It is that. It's also the fact that we are having issues here in our labor market that are not being reflective, and we're also seeing people not want to spend money because of where prices are and what things are costing, and also the interest rate to buy things. So now you understand the issue. Now you understand some of why this guy's saying this. This is super aggressive in my opinion. But nonetheless, they are way behind the 8 ball once again. And I think that's why he won't cut. I'm going to just give you my 2 cents on this and be subjective and you can comment. I don't think he'll cut solely because it will look like he's doing it for 1, political reasons, and 2, it'll look like he made a mistake. So I think they'll just go to September and let the chips fall where they may. And maybe they'll do 50 basis points, maybe they won't. But something's going to have to break for that to happen. What I want to show you is this chart. It's by Arete, and this will have the NASDAQ on it and LSEG solve their data stream. But Arete does great work, and I've showed it several times on this channel. I like looking at historical data. I find it extremely helpful. What you'll note is right here at this particular time, what do you have? You have a cross. From that cross on, these two were intertwined in an inverse relationship. When did that inverse relationship really kick off? Okay, and you start looking at these dates, and you can actually say, well, probably right around here, you could see the inverse relationship really start, right? Here's the cross, and then here's the inverse relationship. And then you're like, well, geez, what happened in this period of time that would have gotten the NASDAQ to lift and for this to start kicking in? Everybody remember what happened in November when Powell said we're going to start cutting rates? And then all of a sudden this trade started following in tandem, but flipped. Okay, that's when they started really pressing this trade because they knew that they were going to cut rates and they didn't think Japan was going to do anything. The disparity continued for some time between these two, and they were no longer in lockstep as they were in here. Now you have this huge differential between these two trades that usually trade somewhat in tandem. You get the cross and then you get a correlation. The inverse correlation, what he's suggesting is that they need to cross again in order for this to be done like they did here. That's going to be extremely painful if he's right, because what you're looking at is you're looking at percentages. And so when you look at those percentages, you kind of have to take a look at this and go, well, from the dollar standpoint over here, where are you talking about to get to the yen? And that's a drop from about the 130 to the 150 level in the yen. And then if you do the inverse over here where they're doing 19, and obviously they're doing just a scale from 19,000 over. But if you start looking at this from 19 down, you're looking at about another 10% drop here at a minimum, depending upon how fast these two correlate and move. So this is where people are kind of alluding to. So is this over? I don't think it is. I think you might see rallies, but even today, did we see real lift? And we'll get to that in a second. Now, it's really important for me that you guys understand what's going on so that you can act on it. So your comments are always appreciated. You could watch Saturday's video, which I'll link at the end of this for more of this. Here's the piece that I don't think people are getting. And this is the Wall Street Journal. This is the one issue that we have. We have 3 major issues. They are inflation, they are geopolitical risk of war escalation, and they are the Japanese carry trade. But the carry trade got a little more wonky. Bank asset managers and others have also been borrowed at the Japanese currency. They were encouraged by Japanese negative rate interest, which only ended in April. Western central banks began aggressively raising rates to combat inflation. Japanese banks had lent out about $1 trillion to foreign borrowers in yen as of March, up from 21% in 21. So anyone that's in this trade now has to understand that they also have Western central banks that are also in this trade with them. Not in the carry trade, just in the currency. They have, it's right here, we're encouraged negative interest rates. So just understand they're in this as well. Much of the recent growth in cross-border yen lending has been so-called interbank markets, where banks lend to each other and non-bank financial firms like asset managers. The problem, Turner says, is it's been expensive to hedge the currency risk As this goes up, right, and spread, the currency risk, it gets expensive to hedge. So you know what you do? You don't hedge. Microsoft doesn't hedge their currency risk. As they rush to do it now, essentially creates more demand for yen. This is a vicious cycle, and the yen strength causes investors and others to close out weak yen bets, yen buying more yen. And the cycle is complete. A lot of arrows there. Now I know you're saying, how does this affect me wanting to whack around the video for 10 points? We're getting there. Mid-East braces for more violent attacks of warning of Iranian attack. I don't know about war, but it seems to me like maybe you shouldn't announce when you're going to go to war. It's just a thought. But nevertheless, we get this all the time. And it seems like it's just incessant that we're getting this. But my sense overnight is that between the risk of, does Japan have this under control? Yes or no? I'm thinking that they don't. The next part of this is going to be, are we going to have war tonight or escalation of war? Yes or no? I don't know. You have earnings tonight, but they're secondary, and we'll get into that. So the idea of holding new longs overnight for not knowing what I'm going to walk into tomorrow, and I have the VIX at a new closing high, despite the fact that it backed off, makes me just want to get out of the way. And most institutional investors felt the same way today, and you could see that. Now, as I said, we were going to jump around, and that's exactly what we're doing. This is from the Wall Street Journal. It came out about 6 hours ago. And I wanted to just show this because I think it's pertinent. So here's interbank loans and loans to non-bank financial institutions. And they're showing this, and they're saying this is where you're at now, and this is why the yen carry trade unwind has further to go. Now, do you know what every investment bank is doing on the street right now? They are looking at their yen risk and wondering, do we have any of this on the books? This is no different than the great financial crisis, where these guys don't even know what they have on their books until they have to go to their risk department and go say, how much at risk are we here? And then they find out how much at risk because they have all these different departments, and then they have a number. And I think we're just getting there. I think this first article out, quite frankly, is the first time that anybody's even talking about this. And I think it's a problem. I think it's a larger problem than we think. That doesn't mean you're not going to have volatility and you can't whack them around. We did that a lot today. We did very well with an Apple trade, some other trades off the open, and I'll walk you through that in a bit here. But understand, it's not just the hedge funds that are selling the yen, buying the dollar, buying the bond market. It's also these banks that are trading these loans in between one another, interbank loans. And you don't know who's left holding the bag. That's where it becomes the issue. This is exactly what happened. Very similar to where one firm could turn around like AIG did and wind up that, hey, by the way, you're on the wrong side of this entire trade. And for someone to come out right now and say, well, that's not possible. It's possible. We've watched it happen several times over my lifetime in trading. That coupled with this war is going to keep people out of the market. And this is exactly what people saw today, and I want to point it out. So this is Bill Gross, and my advice would be to follow him, especially during this time. So he is considered the bond king by a lot of people. You will see one of his disciples on TV all the time, and we talked about him about a week ago. Too much leverage in the global financial system with Japanese yen strength and overdone treasury yield declines a key to unwind. Too much level in the global financial system. You see how this is starting to pop up? What's the language that he's using? Too much leverage in the carry trade? No. Too much level in the global financial system with the Japanese yen strength. This is why you want to follow him, and this is why you want to parse the words. What the heck is he actually saying? What does this mean? Well, now you know because I just walked you through it. Interbank lending. And we don't know who's out there holding the bag. I'm not buying in the small recovery from the morning bottoms. Not selling either. Market's too volatile. Bid-ask spreads are extremely wide. And you're seeing this across the platform. People were having trouble with their positions all day. Now, does that mean that you shouldn't trade? No, far from it. What you're going to do is you're going to get opportunity. What you need to understand is I have war risk. I have carry trade risk. I have interbank relation risk. I have inflation turning into deflation at a rate that is just accelerating to the downside. We understand all the risk. And now you go forward, and now you develop systems that work. So for me, this was relatively simple. I felt that people were going to go after this name because it was just going to get hammered because of what Buffett did by selling 50% and everything else. So all we did was just wait for the setup, and then we were able to get in here, and we were able to pull actually $10 out of the trade. It went very well. And those kinds of trades, they work. But while we're looking at this, just see, after the first 10, 15 minutes, you went nowhere today. So please take that into account. But here, let me show you how we did this trade. You're trying on Apple. You're trying. You came right to that low and you're trying. There goes Apple. You do have buyers, but you're going to have to use that level. I'm going to buy Apple here, and I'm going to use that 198 and see what happens. And then you could always go out there and buy calls as well. Geez, I'm already up $1. I'm going to watch this Apple because I might just take some of this right off here. like right into that push. Actually, I'm up about $2. I pulled some out on that Apple already, and I'm probably going to pull out more in a minute here because I don't trust anything here. Pulled out more, and the market's not running. It's kind of hard to believe that this is just going to run. I'm going to kick more. I'm at a half already, up $2. I can just leave the rest where I'm at. And now it's a break even, worst case. And worst case, I own Apple. Apple 206. 207 was actually resistance, trimmed. We knew this was resistance right up here. We talked about this before. We looked at that on a daily chart, just trimmed more. So I'm out, and then the rest is break even at that point. Thank you very much, and go from there. The strongest has been Apple. I'm just staying with it for what I have right now. There's nothing more for me to do. Once this forms, I'm going to use that low, and that'll be it. And if it stops me, it stops me. And we're stopping at 210, which is a resistance level on Apple. And we know this. We've discussed this. It's even in the newsletter. So if you just take that 210 area right here, bonk, 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 right? You can say it. So we need to make sure that we flip that. And if not, we'll just kick it. You're already starting to reject here. We got to start watching that. You're starting to roll on Apple, and that's a clear rejection. I need to see how clear the rejection is. So here's the problem with Apple, and I'm going to blow out the rest of my Apple right now, and then I'll show you the problem. But I'm selling 100% of my Apple position. Here's your problem with Apple, and this is why I look at multiple time frames at once. See the 55? I got right to it, and I rejected. I don't need to be around for that. It's already telling me I've got a problem, that institutions are selling. I don't need to be around for that. So I locked in that profit and I sold 100% of my Apple position. I could be early selling here. I don't care. I really don't care. Now, I hope you found that helpful. There are a couple things here that I would point out and note. I think you should be looking at multiple time frames all the time, but I really think you need to be looking at multiple time frames now. For example, I use a 55, a 22, and I use a 12. I will switch all these over color-wise, but we're trying to get this to yellow. That's what's in the comments, and I do like that as yellow. But here we are at 55. We got right to it, and we completely rejected. So most people are going to look at this and just go, oh, well, we had a good day. No, what you had was you had a bunch of people that bought the dip, and a lot of people that were short that covered the short. Because why wouldn't you cover your short today? See, once you got back to break even on a lot of these trades, they started to have issues. And I'll show you what I mean by that in a second. So is this over? I don't know. And I think it's a really tough swallow to just say that's it, that's the end, because of all the issues that I just pointed out. None of them are resolved. We don't have anything with the war escalation resolved. We're not even back to status quo. We have nothing with the Japanese currency issue resolved. So is this over? I personally don't think it is. It usually doesn't end like this. And here's my larger issue, and I'll explain this. And I'll show it to you through Apple, for example. Here's my larger issue with this. It doesn't end, this never ends with a buy at the bottom like this on a gap down. It ends when retail buys and they get smoked. It never ends when retail just goes, oh, I just have to keep buying the dip and I'll be fine. No, that's not usually when it ends. Now, I am curious about some data points, and I will show you them because we are seeing signs of, could this be the beginning of a bottom? And the answer to that is yes. But the idea that we're just going to miraculously go by and trillions of dollars is just going to come back in the market and all our problems are going to be fixed, I have a real tough time with that. As somebody that really likes NVIDIA, for example, we got down to a level today that made a lot of sense. And I tried a couple times. I made a couple dollars on it, but not a lot. You literally had to buy blindly into these levels, and then you were just spraying and praying. I mean, it was really that simple with some of these names. I'm not saying it didn't work. I felt it better to go with these kinds of names, and I would suggest that you follow this. What you're looking for here is names of interest. So in other words, this made sense for us right where this alert went off to start looking at buying calls. And we bought the 600 calls today. I think we paid $30 for them at one point today. They were over 50 something. This made sense because I was going to get a huge move and that was going to eat up the implied volatility. And also people are going to want to get in this ahead of what? Earnings tomorrow night. So, you have that. But these gap fills are what you want to watch because anybody that's getting over that gap fill, they're rejecting. And it's not just one, it's all of them. So if you go to AMD, what they did here was they ran you up over it like, oh no, we're good. And then they fought that area. Now, at the end of the day, you lifted. I wouldn't put a lot of faith in this. I really wouldn't. I think that what you're seeing here, and this is what's bothering me more than anything about this here. Okay, AMD, of all the names that you have to bottom feed, people say, well, it's a 50% correction. But it's not the best. It's not best of class. Right? We all know it's not best of class. So why would that chart look like that versus some of the other semiconductors names? It just wouldn't. You could say, well, NVIDIA looks similar to that. Does it? You couldn't even get over the close, the previous day close. And you just sit and you put the most simplest of indicators in there, and you're nowhere near the 55, right? Look at the 200. So what's most realistic here for it to happen? Maybe we trade up, maybe we don't, but hopefully you can see where I'm going with this. So the AMDs of the world rallied, okay? And they're not best of class. What else rallied? CVNA rallied. Okay, does that make sense? You hit the 55 and you rallied off of it. So some people say, well, yeah, that does make sense. But this was something that we shorted and did really well with. All I did was wait for it to get back up to the gap fill. And then from there, you could just see the battle. And then when we started to fade, we just wrote it down. And candidly, at this point, I'm still short and have puts. And I'm comfortable with it. Dell came out today and said, by the way, we're going to have to lay people off. And you couldn't even get up to the 200-day moving average. So to look at this and say, we're fine, I don't get it. I do get, can we bounce and are we oversold? That's a conversation we can have a lot of fun with. So the one thing that I like to do, and I'd like to find a way to share this with people so that they could actually say it, but I have 4 charts in here that are S&P percentages of the M&A and moving averages. And I'll show these here. So let's get to that. We should probably go look at that RSP link. So the first thing that I always do is short term. Where are we short term? And this is stocks above the 5-day moving average. And you can see right here, where are we? We're at a 3. Okay, usually when you're down here, you're setting up for a bounce. Okay, you're setting up for some kind of short-term bounce. And that's good. That's good. So maybe tomorrow, and this was my thought on even holding overnight, why I didn't really want to hold overnight because of all the risk with Japan and everything else. But tomorrow I would look at the market and go, okay, see, I don't need to be first into this stuff because there's always more pain and you just don't know where it's coming from. But with something like this, you're going to look at it and say, all right, well, if I looked at this and I went to this one, you're going to note that Tuesday, April 16th date, we can go to that. Just like you could go to here on the 50-day, see S5, FI. And what you're going to see here on the 18th is that was 27%. Well, 50 days, we're down to 44. So are we really near a level that's a bottom on the 50-day? Not really. Okay, this is where you were when you bottomed in November. You were at 8%. Are you there? Not really. 20-day moving average. And then you'd come here and say, well, this is right where we were in May. Well, how about April? Okay, you were at a 3. Where are you? A 30. Okay, so are we near a level that we need to be at with everything else that's going on? No, we're not. Okay, so we're not at levels. When you see how this is moving, that's why I have it all in one chart. So you can look at this on all 4 on April and look at those readings on April and look at where you are right now. Now, what is helpful to me is if I look at the April level and I look at the 200-day moving average, this is the one you really want to have because this means that they're really starting to panic a little bit. And I don't know that you're getting back down to something like this. Maybe you are. Maybe you're going to have a day of just sheer panic. But this was not capitulation. This did not feel like everybody was just panicked. This was a gap down that nobody reacted to. They were already locked in and then they just held and sprayed and prayed into names. And that's a little different. But there are some other signs that this could be starting to form some kind of bottom. I at least think that there's a potential bounce out there. Now that you're down to this 3, and you can go and look at this on the NASDAQ, and you can go look at this on the Russell as well. These things are pretty washed out on the 5-day. So is there a short-term bounce out there? There can be. It still doesn't make me feel warm and fuzzy about holding tech names overnight when I don't know what Japan's going to do since they were limit down today to circuit breakers. So you're just buying and you're hoping. And that's not really a strategy that I employ. I would just rather stay out of the way and just let it set up. What's the hurry? I mean, market's not going anywhere. So here's interesting, because if I look at the RSI here, and this is where the RSI was in November, and then we stopped. And then we stopped here in April, and then we stopped. If we can start getting some kind of uptick in here, well, that's of interest. And then you start looking at the 4-hour, and if we start looking at that 4-hour level, and let's go back just a little bit here and go, okay, well, where were we on the 4-hour that broke here? Here, here, here. Well, all of a sudden, you're getting spots of interest, right, for short-term bounces at an absolute minimum. And I think that's of interest to me, and I think that's worth paying attention to. On the weekly, not so much. On the weekly, this can get a lot worse, right? And you have a double top with a negative divergence there, by the way. So, and then go look at the Qs, same thing, and you just made the lower low. So this is actually what you refer to on a weekly as a negative divergence because you made the lower low here, and you still have a higher low here. So that's what you'd call a negative divergence. This is what I'm saying. You might have a short-term rally that's led by more pain behind it. And so I think you want to be more safe than sorry here. For me, these types of areas are always capital preservation. If we sit here and go take a look at the IWM, we can see how we're hanging in there. We're hanging in there fairly decently, right? What I think is always pertinent is just trying to figure out where everybody is. So picking swing lows and just marking them off with anchored VWAP. There's a time to use anchored VWAP and there's a time where it's just exhausting. You could put them all over the chart and go, see, it hit here. But when you start taking these lows from November and you drop an anchored VWAP on them, you want to see where you're at. You want to say, okay, is the average person that bought at the November low, are they up or down? Because if they're down, Well, that's going to be an issue. Isn't that convenient how that held there too? See what I mean? Like there's times to do this and look at this data point, and then there's times not to. So what's holding up the best? The SPY. But that's what you want to do. You want to make sure that you're not breaking those levels, because if you are, then you're going to have a problem. If you look at the day, you're up on the day, but you're not really up in regards to everything because people did not, once again, have a chance to react. I do think that there could be a bounce out there. And then again, if you look at some of this other stuff, which I tend to do, which is the Ichimoku chart, the cloud in and of itself. And I'm just trying to give you a frame of reference here. If you look at the SPY like this, and you go take a look at the Qs like this, you broke. You're through all these clouds. Now, the last time you got through, once you popped back up, it was on. But this has some work to do before you pop up. And then you look at IWM. So which one would you want to be in? Which index out of these three would you look at? I think it's pretty clear, right? And you might want to look at the SOX and say, okay, well, how is this working? And where are we with the anchored VWAP? We're below and we broke. So that means the average person that bought a semiconductor stock since November is now down. So is this an area of interest that we might want to watch? And we probably want to put some alert there and just be aware of it. I think if you take this kind of connotation to it, I think you'll be fine. I think if you are out there looking at names like Tesla and saying to yourself, oh, I just want to buy it because we're clearly going to go back up, I think that's where you're going to have a hard time. Or NVIDIA was the name to buy, so we should go buy that again. To me, NVIDIA was extremely disappointing today if we go and take a look at it just for the briefest of seconds. You popped up over and then you just flatlined. And really, if you go and look at it, you couldn't get over, and you should go and look at this a little bit. And I don't want to spend an hour video tonight, but you might want to go look at the 4 o'clock level, which is when Asia has access to US markets, and see if your stocks got over that level or not, because that will tell you what they're thinking about what's going to happen this evening with Japan. That's it.